And now, an Envision Financial Podcast with Luke Smith on Canberra's 2CC.
Luke Smith, I guess that'd be you.
That would be. I hope it is. If it's not me, we've got a big problem.
Oh, yeah, absolutely. Welcome back to the studio. Hard to believe that a whole week has gone by since last time, especially since we had the long weekend, the Monday holiday, and when I came to work on Tuesday, it felt like Monday.
I know, and then I voluntarily put my foot in it by saying last week I'm coming back a week early. I've got some spots. Well, didn't I? Didn't I live to regret that on Tuesday, Wednesday, and Thursday? But that's okay. We, got through plenty, so it's a week well had.
You had a few people taking up the invitation.
Yes, it was. Yes, I've got to be careful how I open those doors in future because my girls in the office were not impressed.
Wow, you were in trouble. All right. Today we're going to talk about how to use an in-specie transfer to increase your super value without cash. Now, the first and most obvious starting point here is going to be, what on earth is an in-specie transfer?
Yeah, so this one was actually a request from a YouTube subscriber who said, can we have a show on in-specie transfers? So here it is. For some context, an in-specie transfer is simply the transfer of an existing asset without its physical sale in the market. So, for example, I've got $100,000 of Commonwealth Bank shares, okay, and I want to transfer those shares into my super fund. I want to hold them, I want to retain them, and I can transfer those $100,000 worth of shares into my super fund. And in specie simply means in its current form. That is very different to saying I'm going to sell that holding down to cash, I'm going to put in the cash, and then I'm going to buy them back. Now, this is very prevalent for your lumpier types of assets like commercial properties. Okay, a lot of self-employed people may own the building that they run their business out of, and they may or may not own it in their super fund. Now, there are specific assets that you can use this for, which we'll get to, but it's about just considering the long-term structure that you're going to hold your assets in, or do you have assets that you've amassed that you want to start progressively moving into your super fund to lower the tax on the earnings or to bolster your balance leading into 60 and starting a pension?
Well, I'm going to ask the first question that pops into my head. Doesn't that constitute a change of beneficial ownership and trigger some sort of tax obligations?
100%. And the next bullet was going to be, do this with caution because it is technically a sale.
Yes.
As you've said.
You're selling it to yourself.
Correct. It's a change of beneficial ownership. So you've sold it from my name to my super fund. And the thing that people need to keep in mind with this one is you cannot ignore or not consider your broader contribution rules as well. So what can I transfer? You can transfer a listed share, a widely held asset, which is a managed fund or an ETF. You can transfer a commercial property. You cannot transfer in this manner residential property or collectibles. So don't assume that it applies to everything because it doesn't. But if I have a building, say I have a $700,000 building and I'm about to retire and I want to move that building for cash flow purposes into my super fund. Okay, I don't really want to sell it. I want to keep owning it, but I know long term when I start a pension, all the rent that I get from that building will be tax-free because a pension is a tax-free entity. So I move it from my name into the self-managed super fund. So I first say, is the asset an eligible asset? Yes, it is. Now, am I eligible to make a contribution? Regardless of whether it's the property, shares, or cash, we know that you can only put in $360,000 in one go as a non-concessional contribution, and you can only put in $30,000 as a concessional or deductible contribution. So you have to look at that and say, how much of that can I use? Which would mean you'd need to consider your total super balance, which we spoke about a couple of shows ago, which talks to your eligibility to make a contribution. So don't just assume, oh, well, I'm moving in a building, that's great. You've got to check first as to all of the normal rules. Can I do it? How much can I put in? I might then say, okay, I'm going to transfer in the building. I might claim $360,000 as a non-concessional contribution. My wife might claim $360,000 as a non-concessional contribution, giving us $720,000 worth of room. So we've now got the room in our contribution ledger to transfer that asset in. we then need to consider, what's the capital gain implication of selling out of our own name? Because we are going to potentially create a tax liability, as you mentioned, in the selling entity's structure. So again, some good tax advice here is very, very prudent, because it's not just a simple transfer. There are specific off-market bits of paper that you need to undertake, but I want people to remember that you still have to be eligible to make the contribution under all the normal rules. And then, is the asset I'm going to move eligible? And if so, then how am I going to do it, and when am I going to do it, and what are the tax implications? Because it's really just about holding something that you want long term in a more tax effective environment. But again, if the capital gains is huge, to sell it, you might not do it. Again, just because it's available doesn't mean you have to do it. A lot of people take advantage of this because they may not have sufficient at call cash. So we get to 30 June and we often talk about reaching a $30,000 limit or using the catch-up legislation over a 5-year period. So you might be able to put in $100,000 of deductible contributions. Great piece of legislation to use if you have no super, because you could put the building in, call some of it deductible, some of it non-deductible, and get it all in, and then help mitigate a tax problem on that side. You could also take a much smaller approach to this and say, I've got a $30,000 limit. I get $15,000 from my employer in superannuation contributions. That means I have a $15,000 cap space. You could move $15,000 of Wesfarmers shares, provided your funds allow an in-specie transfer, okay? So check before you do it, because not all funds allow it. You could move $15,000 of Wesfarmers shares into your super fund and then claim that as a deductible contribution. So it's really about thinking, why am I moving the asset? What is the benefit of moving the asset? And then what are the implications of moving the asset to the entity that currently owns it?
So if you're transferring a building, as an example, into your super fund from your name, and it amounts to a change of beneficial ownership, when you buy and sell real estate, normally there's this very nasty thing called stamp duty. Are you also liable for that?
Yeah. So again, it's not the silver bullet. It's not a shortcut.
The stamp duty can be quite expensive.
Exactly. And that's why I say you need to make sure that you've got everything covered. And this is where your accountant would add huge value to sit down and say, right, let's pro and con this idea. And if the answer is, well, no, it doesn't stack up, okay, off you go. So again, every situation is going to be slightly different, because there are exemptions under different bits of legislation, especially for commercial at different levels. And this is where tax advice is vital, rather than just racing out and doing it because all the guys at work are doing it and everybody you know has been doing it, so I'm going to do it as well. Your situation, your cost base, your tax, your marginal rate could be different to somebody's. You also then want to think, well, do I move it after I retire? So with the transfer of any asset or the sale of any taxable asset, it might be that you retire, wait to the next financial year, and then move it in a year where you don't have salary remuneration, profit or drawings out of your company, to reduce the capital gains tax implication on that sale. So it's very much about it's a horses for courses thing. Don't just leap out and do this, but also just be aware that things have been tight lately. People's cash flow have come under pressure. Cost of living's gone through the roof. Whether we have a rate cut or two or not, well, that's not going to change people's cash flow that significantly that they're now just raining, money. So keep an in-specie up your sleeve as a way to minimise your tax situation where you might be a little bit cash strapped, but you do have accumulated asset in various entities that you could potentially drip feed in over time. And that's one of the nice things about doing this with listed shares is you can cherry pick the exact amount. Using a building is far less liquid, and you don't have a lot of scope to manipulate the value of the transfer. Whereas with a share, you can have $100,000 of Westpac shares. You can move 50,000 of them. You don't have to move the entire parcel. So it's very flexible in relation to your situation and how you then use that legislation to your advantage.
The other thing about capital gains tax, of course, is that a lot of people sort of make the assumption that it's a separate tax, and it's not. It's just a component of your income tax. So if you have no other income, it actually drops you into a lower tax bracket and you pay less.
Yeah, capital gains tax is just income tax by stealth.
Yes.
really. And if you own something for more than 12 months, you get a discount on that gross gain. So if I had $1 million building and it cost me $500,000 to buy, I've got a $500,000 gain. I've owned it for more than 12 months. That's now $250. You might say, okay, well, who owns it? Well, me and my wife. So now it's $125 each. Then you just say, right, what's the tax on $125? It's just like wages. So you're right. Everyone comes in and goes, oh, but what's the capital gains? It's just income tax. You've just got to jump over a couple of hurdles to get to your number. But you're right. It's just about understanding the implications. And again, that's where depreciation and costs and improvements and all of those things can have a huge impact on the tax implications. And tax advice from your accountant is vital. But it's a very, very good way to bolster super leading into retirement, to get lumpy assets into superannuation, and to then be able to decide which threshold you apply. Because as you say, we've got 30,000 on the deductible side, we've got 360 on the non-deductible side. So you can get a very, very large amount of money in very quickly. And you may do it, again, get some specific advice. You might do it over 2 years and go, there's part this year, part next year. So again, you're only limited by your thought process and your strategic ability. But again, it's something that I think is very much overlooked, because a lot of people make the assumption that you can only add money with cash to super.
Yeah, but do your due diligence, because there are costs, particularly in terms of tax and stamp duty and 100%. That sort of thing. So do the maths, get an accountant to do the maths, and figure out whether or not it's going to stack up, and it leaves you better off or less well off.
Exactly. And again, because I'm not an accountant, so I don't do the tax side of it to any great detail. So get somebody involved that is in that space, because they will make or break this strategy 100%.
Fantastic. And if you're operating a self-managed super fund, you've probably got an accountant anyway.
Well, you would hope so. But even if you don't, I think, there's a great example why people say, why are self-managed super funds great? This is one flexibility and the control that people want around how you're structuring pensions and the taxable components that come in for the next generation. It really does come back to the feasibility of that entity.
Luke Smith from Envision Financial is with me in the studio, explaining what an in-specie transfer is and how it can increase your super value without cash. It's 11 minutes to 5. We'll be back with more in just a moment. Seven minutes to 5 on a Friday afternoon, and that means that Luke Smith from Envision Financial is with me in the studio today. We're talking about the most esoteric topic you could possibly imagine.
Yes.
What is an in-specie transfer and how you can use it to increase your super value? So we've covered what it is,
yes.
But what are the key strategy tips to remember when making an in-specie transfer?
Yeah, so the first thing we need to do is look at our eligibility to make a contribution to start with. So that would include looking at the amount you want to put in, then considering your total super balance at 30 June of the year you're going to do it, to make sure you have the room. Because if you have more than 1.66 million in super at 30 June, you cannot put in 360,000. If you have less, yes, you can. And it tiers up 360, 240, 120. So the closer your total super balance is per member, not per fund, per member or per person, the closer you are to 1.9 million, the less you are able to put in one go and not claim a tax deduction. So check that first. Then check and say, is the asset I'm going to in specie an eligible asset? Is it a listed share? Is it a commercial property? Is it a widely held investment? So a managed fund or something like that. If it's resi property, if it's collectibles, stop, think again, because you'll be in breach of specific pieces of legislation. So once you know you're going to put it in, check that you have the room, check that you have the ability to. If you're too old because you're over 75, then it's not something that you can do. This is also something that you can use as part of a CGT small business concession strategy when you're winding out, because there are very large thresholds under that legislation that you may be able to dovetail into this. So keep that in mind for the self-employed. Make sure that you've completed the necessary paperwork and done it in a timely manner. You don't want to be doing this sort of stuff on the 30th of June because it's not a quick process, but you need to make sure that all of your I's have been dotted and your T's have been crossed. Get some tax advice if you're not sure, because as we said before the ad break, it is a change of beneficial ownership, which means it's a tax event in the name of the entity that is selling it. So make sure that you understand the implications, because there's nothing worse than moving something in because Billy at golf said it's great, and then all of a sudden getting a $200,000 tax bill and you don't have the money to pay it because you made a non-concessional contribution to super, which represented the property itself. So think about that. Remember that you can use shares and dial down the amount or the parcel that you transfer. So if you get $15,000 from work and you've got a $30,000 limit, you could transfer $15,000 of shares, or it could be multiple shares. It could be 5 of Westpac, 5 of CBA, 5 of Wesfarmers. So it's very flexible when you talk about listed investments. But consider those, and also check that the receiving fund will allow it. Don't just assume that your industry fund will let you do it, because if your industry fund does not let you buy listed shares, there's a 99% probability that you will get da-dong, no deal. Okay, so check first. Don't go to all the trouble of paying for tax advice, fill out all your paperwork, and then find out that your industry fund won't take it. There's nothing more frustrating. And then I think make sure that the long-term benefit is very, very clear as to why you're doing it. I've got a commercial building. I've got a ton of shares. I'm going to move them into super. I'm going to start a pension. I'm controlling my tax-free status to the kids. I'm controlling my tax-free income in a pension, and I'm controlling the liquidity of the assets in the super fund, because you never know what you're going to need to draw on, and properties are rather illiquid and can be hard to sell part of the kitchen without selling the entire asset. So make sure your why aligns.
So, Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. That's Envision with an E. We've got all of the backlog of the podcast on the resource tab there. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra, where we've got all of our recorded shows. You can watch them on your phone. And all of these types of things are in Smart Money Strategy, your ultimate guide to financial planning, in all good and bad bookstores.
Fantastic. We'll catch you again next week.
See